Welcome, everyone. My name is Mark Steele from Richardson Capital Management, and with me, as always, is our Director of Investment Management, Dan Brown. This episode of the Economic Investment Update is going to focus on April of 2025. And Dan, it's no surprise that the tariffs are the big story from April. President Trump came out early in April 2nd and changed the policy drastically. Dan, the market reacted with a severe downturn. Can you just talk a little bit about how investors, their reactions and, what their actions were based on?
Yeah, so the tariffs definitely introduced some volatility into the market. So it's been a very on again, off again policy. So again, as you mentioned, with April 2nd is what President Trump is titling Liberation Day, and that's where he announced the tariffs. So the tariffs were kind of a couple different pieces. Let's just break it down real quickly. So the first part was what he referred to as a 10% baseline tariff, and that's going to apply to all countries, all imports. And then later, he also applied some what he referred to as reciprocal tariffs, and those are very country specific. And then that introduced a lot of volatility into the market. So we basically saw a 10% decline in the stock market the following 2 days. And then when those reciprocal tariffs were supposed to take effect on April 9th, he basically walked them back and pushed those reciprocal tariffs out 90 days, but the 10% baseline tariff is in effect. So the graph that we're showing here basically shows kind of a longer term history for the tariff rate for the US. So we see going back to the late 1890s all the way up to current date. And we can see that the effective tariff rate prior to the April 2nd announcement was about 3%. And that is jumping up drastically to just over 25% based on some estimates. And our read of what the market was anticipating was an effective tariff rate of about 11 to 15%. So quite a drastic change from what we saw, and that greatly unnerved investors, was a negative shock to the environment. And then later in the month, what we saw is the president kind of walking back a lot of those tariff announcements, and we actually saw the stock market rally, but still finished with a very slight decline for the month. And the last thing we want to emphasize is, this tariff policy is pretty much self-inflicted. So it can be walked back, we think, just as quickly as it was introduced. And U.S. economy and corporate earnings were in pretty decent shape prior to these, April 2nd announcements. So we're hoping we can get back to that environment relatively quickly.
The uncertainty of the tariffs is certainly a concern for investors, Dan, but what other factors are we keeping an eye on?
Yeah, another factor is the fact that we expect federal spending to be a slight drag on economic growth going forward. So the graph that we're showing here basically shows a longer term history of federal spending as a percentage of GDP or gross domestic product. And you can see the longer term average through 2021 is about 20%. And then the spike that we see in 2020 and 2021 is the result of the COVID pandemic. And I think everyone understands and can appreciate that people were laid off, companies went out of business, and the government stepped in to supply a lot of, fiscal spending. But then even post-COVID, the level of spending is still relatively high, and the administration has been pretty clear that they want to bring this level of fiscal spending down because one way that we've enabled this fiscal spending is by issuing debt. And now we're issuing debt in a higher interest rate environment as opposed to previous years. So both the deficit and the debt are being focused on by the administration. So again, we would expect less fiscal spending going forward, and that could be a slight drag on economic growth.
So looking forward, there's lots of uncertainty, but are there reasons to be optimistic?
Yeah, there are. So first of all, let's start with corporate earnings. So we're in the midst of first quarter earnings season, and results are coming in fairly strong, although guidance is a little bit shaky regarding the tariffs issue. But then the other reason we're optimistic about growth in the second half of the year is that we would expect the administration and Congress to extend the Tax Cut and Jobs Act, which is due to expire at the end of this year. So we would expect those lower tax rates for both individuals and corporations to be pushed out into future years. And then not only are we expecting just those tax rates to be pushed out, but we're expecting other things to be added on. So one of the things that President Trump has campaigned on are things like, no taxes on Social Security, no tax on tips. We recently heard from the Treasury Secretary that for business expensing of capital equipment, that's going to be retroactive to January. So again, there's some other growth items that we're paying attention to for the later half of this year.
Dan, thanks for all that information. So what's our outlook?
Yeah, still retain an optimistic outlook. We still think we'll get some clarity on the tariff situation. We realize the volatility that we've endured the past couple months is not pleasant. We just came within a percent of experiencing a bear market, which is a 20% decline. But again, we think we'll get some clarity on tariffs, and that should help the overall stock market environment going forward. Volatility should tame down at that point in time. And again, we want to stress that the tariff issue is pretty much self-inflicted. So those tariffs, as quickly as they came on, they can pull off. And we were in a pretty good spot, prior to that. So we think we can get back to there fairly quickly.
Good, great. Well, Dan, thanks. Thank you to all our viewers out there. We appreciate your trust and support. We'll see you next month.